There's been lots of moving parts to markets this year, but this week is all about central banks. Hi there everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 19th of March 2024, and before I get started, you do need to be aware that whatever I say is general advice only. It doesn't consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So it's a big week of central bank meetings. Today we had the Reserve Bank of Australia, the RBA, we also had the Bank of Japan, and tomorrow night at around midnight Australian time we're going to see the Federal Reserve interest rate decision for March. Now, the Bank of Japan did lift interest rates today. In fact, it was their first lift in interest rates in about 17 years. They lifted interest rates back to zero. They're actually at negative rates, and they have been at negative rates for, I believe, around 8 years now, since 2015. The Reserve Bank of Australia, here in Australia, kept rates unchanged, which was largely expected, and the Bank of Japan move was expected as well. Now, the Australian market did rise after the RBA meeting, and I'm just going to touch on why quickly. At the meeting in February, we can see that in their statement, they did leave a tightening bias, and I've highlighted it here. They said that a further increase in interest rates cannot be ruled out. That was the statement from February, and they basically retained a bit of a tightening bias. That was a little bit surprising because Australian economic data has certainly been weaker than, for example, the US, and weaker than many other Western nations. Our data seems to be slowing down quite a bit, and yet the Fed pivoted towards more dovish language around October last year, and our RBA was still fairly hawkish in February. Well, at today's meeting, they changed the language a bit. And they said at this meeting, the board cannot rule anything in or out. And so they removed that sort of tightening bias. Previously they said, they can't rule out further rate rises. At this meeting they didn't specify they can't rule out raising rates. This meeting they said they can't rule anything in or out. So it was a removal of that tightening bias from the language, and that was seen as a positive for our market. And in fact our market jumped 25 points after the statement came out. So our market, I think, did quite like that statement. It does mean that, our RBA is starting to think towards rate cuts as well. And I think that, it's probably about time. Our data, like I said, has been a bit weaker than that of the US. Our economy is not growing as strongly. Our CPI is remaining fairly strong, just like the US, but perhaps slower than the US growth in prices. And overall, I think things are looking a little less strong for the Australian economy, and so I think the RBA, like I said last week, might be faced with a dilemma a bit later this year where Australian data has gotten worse and the American data has remained fairly strong. I did mention that last week, or perhaps the week before, that I think we could get to a point where the RBA's got to decide whether to cut rates before the US does. That's something that I think they definitely have not wanted to do. That would dramatically weaken the Australian dollar, and that would perhaps cause, imported inflation to be greater. Keep in mind, when Australia imports things in US dollars, that price gets more expensive the weaker the Australian dollar gets. So I don't think our RBAs wanted to go ahead of the US, but I think that how Australian data is unfolding, they may eventually be forced to consider that. So they did remove the tightening bias. That was a short-term positive for the market. Our market jumped about 25 points after that. I'm not sure it's going to be enough of a change to really keep pushing us higher from here. Going to Japan, and we saw that the Japanese raised interest rates for the first time since about 2007, 2008, and it was the first time that Japanese rates have been above a negative range since about 2015, 2016. And so it was a largely expected move from the Bank of Japan. It comes after a much greater jump in wage growth than anticipated, and it comes after a little bit of strength in the Japanese economy. Overall, though, the Japanese economy is still pretty underwhelming with their fundamentals, their economic data being reported. But regardless, I don't think that this move was a surprise to anyone. And, the market had been pricing it in. It fell a bit at about a week ago now. And it sort of has stabilized since then. And indeed, it actually rose after the lift in rates was announced, and that's pretty much because it was in line with expectations. Moving beyond that, we've got the Federal Reserve, the US Federal Reserve meeting tomorrow night, Australian time. And like I said before, US data has been a little bit stronger than Australian data. Their inflation has certainly been a lot stickier. It didn't come down as expected in January, and then it didn't come down as expected in February. So their economic data has been, much sort of stronger, much stickier from the inflation perspective than our own, and than most Western nations. That does present the Federal Reserve with a dilemma. Now, it was widely expected that they were actually going to cut rates at the March meeting, at the meeting on Wednesday night, and that was expected. Around the start of the year, people were saying March was when rates were going to be cut. They're almost guaranteed not to cut rates now on Wednesday night, and indeed, everyone then said May would be the meeting at which they'd cut. And now that's been pushed out to June, and now June is about 50-50 as to whether they will or won't cut rates at all. And so the timing of a US rate cut keeps being pushed further and further and further out in the year. And so basically what this table is showing us is that around 55% of people think that there's going to be a rate cut at the June meeting or beforehand. And around 45% of people think that it's going to stay the same until June. If you have a look at where the probabilities were a month ago, you can see that the vast majority of people believed there was going to be at least one rate cut as recently as a month ago. And that's really sort of gotten lower and lower as time's progressed. US economic data will have to weaken from where it is currently for rates to be cut in June or before June. If data keeps coming out as strong as it has been, rate cuts will be pushed towards the second half of the year. Now, as the rate cuts have been pushed further and further out in the year, the upwards momentum in markets has sort of slowed somewhat. We'll have a look at that in the charts in a moment, but we can really see that US markets haven't advanced much at all for the month of March. And that's despite, apparently all the positivity and all the momentum from the rally in sort of November, December, January and February. So yeah, with the rate cuts being pushed further and further out in the year, I think we're seeing an increasing chance of a bit of profit taking, a bit of downwards movement in US markets. The other thing I wanted to touch on is iron ore. Iron ore's fallen quite strongly in 2024. It fell around 20% from its levels at the start of the year to a couple of days ago, but it actually did rebound across the past couple of sessions. So that's what this chart here is showing. Keep in mind that in Chinese markets, a red bar is a gain or a rise, and in Chinese markets, a green bar is a drop or a fall. And we can really see that since the start of the year, around the middle of the chart, prices have come off quite strongly. There has been a couple of buying days across the past 2 days, but overall prices are down a fair bit for the year. There's a lot of reasons for this. Chinese economic activity has been underwhelming. There was a lot of Chinese stockpiling around the end of last year of iron ore. And yeah, those sort of factors are starting to weigh on the iron ore price. Even with the iron ore price coming off over the first 3 months of the year, Chinese iron ore stockpiles have actually gone up. So even though we've seen a little bit of a rebound over the past couple of days, and again, I wouldn't be surprised to see a little bit more of a rebound, I'm not sure we're going to see prices head back to where they were at the start of the year. Stockpiles are still high, they've been going up this year. Chinese economic activity continues to look weak. Official economic data does look somewhat strong, but then the third-party data looks a lot weaker. And the suggestion might be that the Chinese government is trying to make the numbers look a little better when they report the official data. So that iron ore price falling has kept the Australian iron ore miners falling. They have rebounded a little bit, and again that might continue just a little bit. But overall, with the iron ore miners coming off, that's definitely weighed on our XGO as a whole. And so when we look at our XGO, we can see that it has come off for the past couple of weeks. It has broken the trend line that has formed since the end of October there, and we did break below a bit of support level at 7,700. Overall, we are still on an upwards move. We've still got higher peaks and troughs. And so now what we'd be looking for is whether or not we set a lower peak than our peak in early March. So we got to 78.50. I doubt we'll get all the way back there unless iron ore really rockets back up. We've seen our banks come off as well. Again, we'll need to see those banks push back up. And I'm just not sure we're going to see all of that happen to push us back to 78.50. For me, the key levels to watch now are the 7,700 level, roughly where we closed today, and then to the downside 7600. If we break either of those levels, I think we'll see a bit more movement in that direction. If we break to the upside, I'd then be looking to see if we stall out below 7850. And if we break 7600 to the downside, it's hard to say where we may stall, but there was a low around 7500 back in February, and then if that breaks, we could come back all the way to 7350. Looking at the US market, and they are right in the point of an ascending triangle. This is the S&P 500, and we can see the dramatic uptrend it's been on so far this year. It's topped out around 51.75, and indeed it's sort of stalled at that level again overnight. They're so far into the point of this triangle that I suspect it'll break any day now. And like I said, we've got the Federal Reserve meeting on Wednesday night. That might just be the event that causes this triangle to break. If they break to the upside, it is hard to say where they may stall. These are levels that the market hasn't seen before, and yeah, that means it's very hard to get any sort of sense of where they might head to. And if they break to the downside, it's again a little bit hard, but I'd be looking at the previous sort of support levels. So I'd be looking around 50.50, which was also resistance, and then if that breaks back to around 49.30, which was support and then also resistance. Overall, I think the risk is to the downside. If they do have further upwards movement, I think that the US will keep grinding as they have for the month of March. This was the start of March here. Really, they haven't added many points to the market. If there is upwards movement, I think it'll be very incremental. And if there is downwards movement, I think there is a bit of room to any downside movement. So I will end it there for this week, guys. A big week for central banks. We had the RBA hold, but move to more dovish language. We had the Bank of Japan lift rates for the first time in sort of 17 years. And then tomorrow night, we've got a major Federal Reserve meeting. Will they push out the rate cut timetable further, or will they solidify the June cut? So that's it for this week. Hopefully you guys enjoyed. If you did, click the like button, click subscribe, and we'll see you in the next one.